Anton, it is good to see you.
Always a pleasure to be here.
Now, you manage money, and specifically you invest in financials. Okay, I want to kick it off with this discussion, because financials have gotten their lunch eaten.
Ouch.
This year. Not necessarily all the financials. I know you like the small and mid-cap names, but what the heck is going on with these major banks this year?
I think you've got multiple factors that are going on, but the way these stocks have traded, it reflects all the damage being done from a full recession. Not a depression like we had in 2008.
Right.
And people are already leaping to, oh my goodness, here we go again, just from the first couple weeks out of the gate. Energy is a problem for banks in Texas, no doubt about it. Energy.
They've made all the loans.
They've made a lot of the loans. The big banks have really big energy loans as well, but it's 2 to 3% of their portfolios. Manageable. You know,
right.
Jamie Dimon said, well, if oil goes here, we write another $500 million off. Well, you know, J.P. Morgan earns, $5 to $7 billion a quarter, so it's not exactly a giant problem for them. It doesn't dilute book value.
Right, but I think the story maybe is more on the net interest margin, right? Because that's what we were anticipating as the Fed began to raise interest rates. Now that seems to be off the table. Talk about that. What's the outlook there?
So if you think about it, I've had some people say, well, banks, reflected that. Well, they didn't, because they really weren't up last year.
Right. No, they were down 3.5%.
They didn't reflect that last year, and these stocks now trade at lower multiples than they did 2 years ago, and the book values are higher, their earnings are higher. I think there's some forced selling that went on. I think the sovereign wealth funds were majorly responsible. They loved U.S. banks. I'm not naming which one, but you know what? There were major holders of U.S. banks, and some of that selling that was going on was clearly like, we don't care. When Bank of America came out and reported good earnings and it went down that day, I was shocked, because I said, all right, well, the stock's going to be up 5% today because, the numbers were definitely good enough. It's been beaten to death. And then it went down, and it continued to go down. I'm going, okay, somebody's just selling for the sake of selling. You've got all these technical CTAs out there selling stocks, period. Quite frankly, front-running potentially that selling. So, the reversal, could be just as savage as it's been vicious on the way down.
That's with Bank of America putting another $1 billion into the reserves.
Oh, yeah.
I was with you. I thought they had a good quarter. Very conservative, building their reserves, and they still got whacked.
Yeah, for no good reason other than they existed, and that's kind of what's happened. I mean, a lot of people sort of scratch their heads and say, why is this happening? I mean, if you look at the Texas banks, actually a bunch of them have reported numbers slightly better. There was a big short squeeze on a couple of them yesterday. One announced a big buyback yesterday.
And the other trend in your world is the consolidation. When you look at the small and mid-cap names, a lot of deals happening. You think that continues?
Well, absolutely. And if we don't get interest rate increases, it actually accelerates. Yeah. Because cost cutting is one of these monster things that the industry still has to do.
That space, though, is really interesting. Anything from $50 billion under, that non-SIFI space is really exciting. And I think below $20 billion is really where it's at, because that's where you get the
non-systemically important financial institution.
Right. And so the regulations from Dodd-Frank continue to hurt bigger banks, but it's the small space where you can accumulate in assets, and that's where I think growth is interesting.
And it's related to the fracking industry, right? We had well over 2,000 rigs. We're down to around 450. I think, Maria, you're right. You're going to see a lot of consolidation in that. Field services are going to be consolidated to get cost out.
So some of this consolidation is going to be forced because of the oil space.
Yes.
Oh, absolutely. Yes. I mean, places like Louisiana and Texas that have real direct exposure, Oklahoma, there are going to be some companies that are going to raise their hands and go, get me out of here. There will be some capital raising going on. There'll be some investors that get in maybe a little too early. It's going to be tough to tell, but I love the Southeast. Economic growth, phenomenal. Wherever it is, the Carolinas, Atlanta.
Even the big guys are letting a lot of land go. The E&P, if you don't drill, you lose it. A lot of them are quietly letting the land go back.
Clearly, the banks have some headwinds, to them, whether it's the Fed not raising rates and that's affecting net interest margins, or it's the energy exposure. But probably the biggest tailwind for the banking sector is growth in consumer credit. And it's been phenomenal, right? 5 or 6%. It's been ramping up. Are we seeing the topping of consumer credit growth here, or do you think there's more of a runway here?
I still think there's some runway here. I mean, let's not forget that all the bad of energy is good for the consumer. Some of the spending we've seen the consumers in the credit card numbers have reflected lack of spending because they're not paying as much for their gasoline. They're able to allocate it elsewhere. They've allocated it to savings as well. Their balance sheets are much healthier than prior to the crisis. So I still think we have some pretty good growth in the consumer.
I think you make a good point in terms of the lending. Yeah, lending looks good, but Anton, here's my question. Are we seeing increasing lending, and that money is going toward CapEx spending, where these companies want to invest in their business, or is it going toward M&A?
Well, so you think about the CapEx spending that's not happening in energy. I mean, all the budgets have been cut way back. So that's, when you look at the broader numbers, you're seeing that sift through. If you remove that, you know, there's still some pretty good growth in a lot of parts of this economy. If you remove the CapEx that was allocated towards the drilling. You know, loan growth is quite good. It's quite robust. I mean, we're talking 6 to 8% loan growth, particularly on the smaller guys. I mean, J.P. Morgan's showing that kind of growth
I know,
as well.
but I mean, is it loan growth because of M&A?
No, it's you know, the bond market has taken a lot of that, no doubt about it. It's loan growth for actually, you know, doing nuts and bolts in manufacturing. Yeah. We're seeing a lot of relocation of foreign companies to the United States as well because of cheap energy.
That's what Bob just said.
Yeah,
Real quick, what's your favorite stock right now?
I love New York Community and I love KeyCorp. They've both been beaten. They've both done deals. They're trading at, you know, forward earnings that are very cheap and large dividend yields.